Now, the Oura Ring that you have, is that second generation, a third generation? Do you see any difference?
So I just bought the new one, which is, I think, the latest version. And as compared to the older version, I've seen that their UI, the way they display things, has changed. They capture information more accurately. But I mean, the gist of what it tells you is still there from the older version, which is your sleep patterns, your sleep stages, how many are in REM, how many are in deep sleep, light sleep. And then when they do some recommendations now, they have certain visualizations, sleep patterns that you can follow while you're sleeping. I don't have any issues sleeping. I tend to be someone who goes to bed and my latency is 2 minutes, which is sometimes red, and it's red in Aura. They tend to say it should be between 7 to I think 9 minutes. I tend to sleep quite quickly because the days are hectic when you're running a company. So I wake up
Of
early,
course, they are.
and then when I sleep, I'm almost like I switch off and I wait for the next day.
There is a German guy, I forgot his name. He has a fantastic YouTube channel that he's doing laboratory tests of all those um, different devices, for self-hacking. And I know that you're a big advocate or a big data collector, testing yourself for glucose
Yeah.
and REM and all that stuff. You gather data. What do you do with all the data about yourself?
Yeah, that's an interesting question. So there's so many things that you can track, right? You can track your sleep, you can track your blood glucose. These are external things. But on a quarterly basis, I also have my biomarkers tracked, like blood works. How are different things operating? And it's very important. What I noticed with a lot of people around me is they go to the doctor, they do their blood test. If the results are within the range, they're happy. Okay, but here's the thing: we don't have a continuous monitor of what's happening inside our body. So what you need to do is you need to track the trends, and the trends are what's important. So if your, for example, blood sugar is still within the range, but over 4 or 5 years you see that the trend is going up, then you need to understand that you're doing something wrong in your lifestyle, and then eventually it will go out of the range. So it's important that you don't just read the reports as they are, but actually to look at trends and compare them throughout the years that what you're tracking. Now that's something hard because the medical practice, unfortunately, you go to a doctor, they tell you you're okay. They look at the results, they tell you you're okay. They do not tell you that, oh, I've seen a trend that's not good for you. Maybe you should maybe tell me more about your diet. Tell me more about your lifestyle. Are you stressed? These are all factors that affect eventually what happens to you. So it's quite, the data by itself doesn't do anything. You have to interpret it and you have to keep track of it over a period of time. It's stressful itself. That's the interesting thing. Tracking the data, interpreting this data is stressful itself. And I had originally, I've removed it now, a blood sugar monitor, and you see sometimes you're not eating any sugar, but your blood sugar goes up and down, and it happens that you're either in a stressful meeting or you're doing some sort of physical activity. You see that movement, and by monitoring it, it even increases the stress level because sometimes it goes out of range. So that's also a double-edged sword, let's say, to track the data, interpret it on yourself. Is it the same with the companies? Absolutely. Your company is just it's just like your body. If you don't take care of it, if you don't know your numbers in your company, it's eventually doomed. So that's how I have this, if you want, apples to apples comparison between how I run my company with data and how I run my body with data.
Well, you have a very stressing job, right? And I think that any founder, any CEO that will work 120 hours a week needs to be there. So, how is that data that you track about yourself helps you to have the frame and let's call it clear mind in order to manage it? Because you also have a newborn. So, that's another job that you have.
Absolutely. So here's the interesting thing. Um, if you're able to mesh things around and get them all interlinked together, and you can do it properly, you can actually work. It can actually work fine. So I'll give you an example. Today we run Asteya as a remote entity. We don't have an office. We have people all over the world. We're around 80 people, and it tends to be very efficient for us. We're very productive, but it also tends to be that we're sitting on our desk for a prolonged period of time, because now we've eliminated the commute. Before that, we might have commuted for a few minutes or for a few hours, depending where you are, and that creates some sort of physical activity. But if you're a remote first company, you're actually sitting in your house, you're sitting with your family, and you also have the laptop in front of you. So it's very hard to disconnect. So what I've done, and I continue doing, is I do all my meetings walking. So I close my laptop, I do my meetings on the phone, I go out to the park where it's quiet, good internet connection, and I do all the meetings that require me to be a firefighter. By firefighter means there's problems in the company, there's strategies I need to look at, there's certain things that I need to attend to. There, it's not like I'm presenting something. I'm not pitching to an investor while walking. I'm not presenting my to the board, but I'm trying to be a firefighter within the organization. So these are things that continuously I can deploy while I'm walking, which incorporates the physical activity with the work. So now I don't have to worry about getting my steps in, for example. Now, the second part of this, because of being a remote company, it tends to be very hard to differentiate between time with your family and time with work, because essentially you're online 24/7. You're always online. You have your phone. People know your home, which is your office now. So with an asynchronous communication, you always have messages popping up. You always have requests. You always have video calls being scheduled on. I share my Calendly, so I'm public within the organization. Everyone can have access to me. So I always tend to have this issue, and I'm a person with inbox zero syndrome. I cannot keep things that come into my inbox today for tomorrow. I try to get them out of the way. Now, definitely, I use a 2x2 framework where if something can be, if something takes more time than 3 or 4 minutes, I tend to keep it for the next day, because I know I need to be probably well researched. I need to make sure I answer properly. And then, more importantly, the other tip that I use, if I'm angry, I don't answer my emails at that day, because I want to be clear in my head rather than emotional when answering emails. So going back to your question, yes, it's very hard, because your life is intermingled as a remote company. You have your family within the house, so you need to find time for them, and this is a big advantage if the culture permits, and that's what we've done at Steya. We've built a culture where we're very flexible, we trust our people, we don't micromanage them, which means that it's not an 8 to 5 job. You decide how do you want to do it. You want to do 8 to 12, then 6 to 1. It's up to you. We're more driven by milestones, by deliverables, by key initiatives. And then this is how we track how people are performing. So you might say, today I'm not feeling well. I don't want to work. I want to sit with my family. No one's going to ask you why. As long as you have your deliverables, you know how to manage your time, everyone is mature in the organization, so we try to do it this way. And that allows the culture to also be family oriented. So if you want to take your kids to school, you want to put them to bed, you can do that. It's not a bureaucratic 80-hour job that requires you to be on your laptop all the time. So that's how I structured it, and I've made it part of the culture within the organization.
Let's talk about your company. Can you give us a background about what is your new venture?
Absolutely. So Asteya is an income insurance technology firm where our mission is to make what we call income insurance accessible for everyone in the US. Our target audience is the US market, and practically it's a form of disability insurance as it's known in the US. But what we've done is we've digitized it. We've made it accessible for a wider audience, so we can cover people who are earning $30,000 per year, or we can cover people who are earning 10 million. So we have a wide range of income insurance product to make sure that if there's a gap in your life, uh, and you want to make sure to protect any unforeseen circumstance that will risk your income, then you can come to us and we will be able to help you do that. Now, we're not a direct to consumer company, so we would not be seeing us promoting our product on Google or Facebook. But what we do is we partner with agencies, brokers, affinity partners who would like to push our products to their customer base. And this approach help us drive our mission faster. Because if we want to do it on our own, it takes a lot of money. It's not efficient. It's not profitable. And eventually we will burn out. We know for a fact because you've been in the InsurTech space for a while. We've seen valuations go up and down. Uh, it's a fiasco. So we're more of an underwriters ourselves. We understand the risk, we find the right fit, and we help the partners, the distribution partners that we work with, to also be more efficient. That means if their sales cycle is, let's say, currently few months, we can drive it down with our technology to minutes, because everything is digital. All they have to do is convince their customer or understand if these products fit any of the customer profiles that they have, and then use our enrollment tool just to push that link to their end consumers so that they fill the application. The customer put the credit card, and then we would issue and send the policy digitally. So that's the approach we're following. And we believe the reason we've approached this particular line of business, which is smaller, by the way, in size than any other lines of business like life insurance or health, but we believe that it's extremely underappreciated and under penetrated. And by that, I mean, there's a lot of people who simply don't know that product exists. We know from the statistics, roughly half of the US population, if you ask them what's disability or income insurance, they might not know. They haven't come across it. And the other part who knows, probably they've heard it from their employer, because their employer offers it as a maybe benefit. Now, the interesting part is that we live in the US paycheck to paycheck, and that's probably half the population or a little bit more, depending where you're reading the statistics, but it's a big number. And if you're earning $1 million and you're living paycheck to paycheck, you are at risk, similar to someone who's unemployed and they don't have any expenses. Because if something bad happens to you, your income is at risk. You're out of work for a while. Who pays your debt? Who pays your mortgage? Who pays your lifestyle expenses? Who pays your children's expenses, your schooling fees? So there's a lot of things at stake if you're living paycheck to paycheck. And we believe that product should be in every person's hand in the US. And we cannot do it on our own. And that's why we partner with other people who have a bigger reach than us, and then can promote this. So that's, in a nutshell, Asteya, the mission, and what we do today.
So, are you an MGU?
We're actually a very interesting company because we're licensed in three different forms. We're a broker, we're a retail broker,
Mm-hmm.
and licensed in all states. we're an MGU, or like you said, an
BGU.
underwriting agency,
Mm-hmm.
also licensed in all states. And then we're also a TPA. We're a third party administrator. So that means we can, handle claims, we can collect on behalf of carriers and do multiple activities. And that took us a while. So Asteya was not born few. It was born actually 3 or 4 years ago, but we were in stealth mode. We were building the tech stack. We were building the products because we had to file them with the regulators, and then definitely we had to get the licenses, which sometimes takes time because you have 50 states in the US. So we went live after 2 years when we were more ready with few products that we could sell to the market.
So one of the things that caught my eye, and I find it fascinating, that you define it as income insurance, although the product that most people are familiar with is disability insurance. What prompted that up?
Is it fair that life insurance is not death insurance?
Yes, it
Disability should
is.
just be a positive, should be just income insurance.
It's
I don't know why,
actually,
and who
I
created
think that
the
I think that life insurance is actually inheritance insurance, or something that you're not going to enjoy it. It's
Yeah,
whoever is your successor is going to enjoy it.
exactly. Exactly. Yeah. So we said disability insurance has a negative connotation because if you go to someone and says buy something that they think they will not need, no one wakes up and says, "I'm not healthy. Something's gonna happen to me, an accident, an illness, a sickness. I'm okay today. I don't need this product." Right? Life insurance is quite different because death is inevitable. Right? So if someone comes to
Hmm.
you and says something is going to happen to you, you're going to die. Okay, yes, that's true. If I have a family, I need this product. So it's easier to convince someone. Disability insurance is something that you think you might not get it simply. And a lot of people, by the way, associate disability insurance with accidents only. So you
Hmm.
fall, you break your leg, this is disability. The reality is less than 10% are actually claims related to accidents. The majority are sickness or illness related, such as diabetes, cancer, musculoskeletal problems that prevents you from going to work. I had recently a chat with a colleague, and they have an editor for their podcast, and she was telling me, my editor has carpal tunnel syndrome. She cannot type anymore, and she's technically disabled because she cannot do her work. And she was saying, you know what? It's weird that she doesn't have a protection for that. She hasn't thought of it. She doesn't know that there's something out there that exists that she could buy. So that prompts the original statistics that I mentioned to you. There's a lot of people who are not aware about this product, and my role in the organization is not only to build the product and the technology and hire the right people. It's actually to come on your show and other shows and try to tell the world that there's a product there that you might need, because you never know what might happen to you, and you need that protection not only for yourself but also for your family. You could be a single person, but you have debt on your or mortgage on your home. You still need to pay that mortgage, right? So it's underappreciated, and I think there's a lot of room for us to see if it fits a gap that we currently have.
I think, and I love that statistics, especially when people don't think, and it's on your website in terms of percentage, and especially it's also, sorry, I will add that it's also very interesting about how it divided into the different gender and their irrationality of assessing the risk and how much it's going to impact them and their future income, because as you mentioned, most of it comes from illness and not from an accident, because we think disability, it's someone was in a car accident or some sort of crash that caused that skeleton problem, instead of, God forbid, cancer and other statistics that will cause some sort of an injury, or, well, basically prevents you from going to work. And we see that increasing in the US because of the gig economy and the fact that, well, people work paycheck to paycheck or the next project or the next hire, and we have less and less full-time employment and benefits and stuff like that. How are you helping them? How are you promoting that and helping your distribution channel, the agents and other brokers, to promote that or to advocate this concept?
Yeah, that's a great question, Gilad. Basically, we we work with national producers across the whole US, and what we tell them is, look at your customer profile, right? What is a gap in their income that's missing today? You've sold them life insurance, you've sold them critical illness, maybe you've sold them workman compensation, right? Do the assessment. Is there a gap there? Is there something that if something happens to them outside work, if they don't die today, if they change jobs, if they change states, if they have a family, do you think there's a gap that you could fill here? If the answer is no, then we come and educate them on the different products that we have and how they could fit different client base. And then what we educate them as well is on the tech stack that we have. So it's a very simple process where they sign up with us. We give them an enrollment link for all the products that we have. They go to Gilad and they say, hey, Gilad, you earn $100,000, you have life insurance, you might need this disability to top up or to bridge that gap. If they say, yes, I have a budget for, I don't know, $1,000 per year, an additional $1,000, then they could give them the enrollment link. They would put the benefit amount that they've agreed together on, and then they fill the application within 5 to 7 minutes. They put their credit card details, and now the agent's job has practically been done at the time they convince the customer that they need it, and then they move to someone else. So technically speaking, not only are they filling a gap and adding value to their client, but they're shortening their sales cycle because we're eliminating any administration that they need to do. So
Mm-hmm.
now, instead of going back and forth between the customer, the carrier, filling the information, sending it to the underwriter, we've cut down all of this. We give them the enrollment link, everything is automated. They move to the next client. So sales cycle is shorter, they get paid faster, they actually solved a pain point for their customer. And by the way, the beauty about the income insurance, it's not like car insurance. The switching cost usually is high. You don't switch often. You don't change carriers often
Hmm.
because this is not a mandatory product. It's a product that you're convinced you need it. And you've worked with your agent to see multiple options and you've decided to go with, let's say, Asteya in that case. Technically speaking, you're not going to switch every year because that's not, we have a product called guaranteed renewability. So you buy it today, you pay today, as long as you pay the same premium. If you're today 30 and you keep paying it till 60, the price does not change because it's guaranteed renewability as long as you pay your premium. And that's the beauty about this product. When it comes to car insurance, every year the price changes. You buy a new car, the price is higher. Health is the same. As you grow older, even with life insurance, if the term is ending, as you grow older, the price goes up. So with disability, if it's a guaranteed renewable product like one of our products, you pay it once, the premium stays the same as long as you pay it. So it's quite a good investment in terms of doing it early in your life. Probably the ideal customer who needs this product is someone in their 30s. They've established a good income stream. They've started to have certain lifestyle expenses, maybe a family, maybe they want to start a family, maybe they've bought a home, they have mortgage. So ideally, this is the time where you might start saving, or if you're living paycheck to paycheck, you want that layer of protection. We've seen people in their 20s do that, but they're more disciplined on their finances. The majority of the 20s people are usually more on the consumption side. So
Mm-hmm.
we see less often that tendency to buy disability. But I think that's technically, if you want, the the flow we follow, the products, and how we position it in terms of promoting it to our agencies.
I'm just thinking about my case, and as we mature, we expect to earn more and more money, and it's not paycheck to paycheck or project to project, it's a year to year. Interesting. What's the source of the name? What's the origin?
So Asteya is a Sanskrit name that means not taking more than you need, and we've put that because our goal at Asteya is to make sure we help people get protected, and we want to make them feel as if they use our product in a way that will help them in the future. So we don't want to take from you, we want to give you. And that's the idea behind Asteya, taking as much as you need versus taking everything that you need from the customer.
Now, I'm sorry, I'm taking it. I have a sorry, I had a few questions earlier that I wanted to ask, and I completely forgot about them. So, can you share who is behind which carrier provides the product?
So we are backed by FSL for few of our products, which is Fidelity, Security, Life. And then we also have around 8 other binders, from Unicre to Lloyd's of London to Wellfleet. So we have multiple carriers behind each of the different products. But the big advantage is we have the underwriting capacity. So we take decisions and we make sure our portfolio is quite profitable because we're underwriters. We're not digital insurtechs that want to grow at any cost. We understand that when you want to build a business, the top line is important, but the bottom line is more important, because that's what defines return on equity, the bottom line. So you can grow at any cost, but if you're losing money, if your loss ratio is more than 100, that's not sustainable. If your cost to acquisition is higher than your lifetime value of your customer, that's not sustainable as well. Eventually money runs out. So we've built Asteya from day one, taking into consideration that profitability is the first metric that we need to cater for. So we build the top line, but we're also cost efficient. We're big on automation. We're very smart on hiring. We make sure that if we want to grow at any cost, we have to make sure that it's sustainable growth. So the unit economics have to make sense from day one. We don't want to make the unit economics look negative and then figure it out in the future. Because if you're in a bear market, that's where the company goes bust. Because you're in a beautiful bull market, you have so much money, and then suddenly the bear market happens, no one's going to fund you anymore, and your unit economics have not yet become positive. This sounds the alarm immediately.
So what I love about you, and I will use the quote from the CEO of Ahoy, which basically said, we are not a niche product, we're just a specialty, and we are coming in more mature. And I love the same thing about you, and I will define it, or bucket it under the fourth wave of insurtechs, which we see more niche, coming more matured with insurance background, understanding that they don't need to conquer the world, they don't need to remove or remove the agents and actually work with the agents. Understand that it's a B2B to C, not just direct to consumer product, and think first about the unit economics, and from there building that business. So I love that it's already become a trend within the insurtech space, and also picking up who are your partners, who are the carriers that you can work with. Now, for you, how do you see, let's call it the first and second waves of insurtechs that mainly in the life space sold term life? I know that it's not the same product, but when an agent come to sell it, they usually start, oh, what do you need? Whole life, term life. And then let me add long-term care, disability, and let's call it the other life insurance products. How do you work together? How do you compete with them if you are competing with them?
So that's an interesting question. If you go to our website today, we've partnered with few providers to bundle the term life with disability, because if you think about it today, they're very complementary. They're both of them are income insurance product. They protect your income. The beneficiaries, as you said, is different. In life insurance, it's someone else. In disability, it could be someone else, but it's usually you. The triggers are different. One is death, the other one is sickness, illness, or accident. Both of them pay a benefit. Both of them have a term. Both of them renew. So they're very complementary because they're adjacent to each other. So if you're someone who's working today and something bad happens to you, let's assume you're dead, right? Term life insurance or whole life insurance is what you need. You have to have that in your portfolio of protection. But at the same time, you might fall and break your leg. What does the term life do for you here? Nothing. You've technically paid more for something you might not need. So you have to manage to get both of them, and that's why they're complementary. Now, interestingly enough, for you to be able to know how much to buy, when to buy it, and at what price, you need advice. And this is where the agents come into play, because these products could be a little bit hard to understand if you're someone who's not familiar with the insurance terminology. So you need someone to help you understand the terminology. You need someone you trust, because there's so many products out there, there's so many companies out there, and you don't know which one has a better reputation. And this is where the rating agencies like AM Best, S&P, they rate these insurance companies, because at the end of the day, insurance is a promise. You are promised by someone to give you money in advance for a service that will happen in the future, maybe or maybe not. So if I come to you today and say, Gilad, give me your money, in the future, I will give you some benefit amount. There's no way you're going to give me your money unless you trust me blindly. You say, okay, yes, I trust you. I'm going to give you the money. Hopefully in the future, you'll pay me back. This is the importance of the agent. And that's why a lot of the InsurTechs who started in wave one, they wanted to eliminate the middleman. They said the middleman's role is not important. They're taking a cut out of the policy, which we can deliver for cheaper. And that means the customer, who are very price sensitive when it comes to insurance, they would buy a cheaper policy. Now, there's so many challenges here, because going direct to consumers means you need to replace the agent by people inside your company who understand insurance and who actually want to do the job of an agent. You still need to pay them a salary. So the cost is not entirely eliminated. That's one. Two, you need to build the trust and the brand, which is very hard. One of the hardest competitive advantage you could do is brand building. It takes so much money to build a brand. We've seen it with many that went with an IPO. They've spent on marketing. If you look at their financials, every year 80-90 million on marketing and advertising. So it's quite an extensive sum of money that you need to do to promote your brand and to build that trust. So the agent elimination also puts you at that risk. And I think the narrative was much stronger than the fundamentals of insurance. And that's where the first wave of InsurTech came in. They got a lot of funding. They've sold the narrative. But the fundamentals were not there. And eventually, as the second wave and the third wave came in, and that industry became more mature on the digital side, the investors became smarter. They've seen now more use cases, they've seen more busts, and now they understood, okay, it's all about the fundamentals in insurance. And that's what you see, Gilad, you know better than me, in the US market, the top 25 carriers are almost the same for a long period of time. They've very well funded. They have strong book of business. They have um, a strong culture. They're slow. That's fine, but that's part of being in a regulated environment. It's a risk management environment. You have to be slow. You cannot be fast and break things, because you break your balance sheet and you're out of business. So there's an advantages and disadvantages there. And I think the third and the fourth wave that are coming in are now understanding that it's not growth at any cost. It's all about profitability. It's about sustaining a book of business that has the right metrics, which means loss ratios beyond a certain number, um, um, a cost ratio or operational ratio beyond a certain number, reinsurance cost, distribution or commission cost at a certain ratio. And that takes time to build. You cannot throw money at it and then figure it out later. So that these are my thoughts on how term life is complementary and how the waves are changing today within life and other lines of business, to be fair.
No, I completely agree with that. And in my head, I'm just trying to think. Uh, I need to bring one or two investors that I worked with in the past to chime in on that and their lesson learned, especially in investing in life insurance products early on, and compare that to other PNC startups. Because I think that there was this aha moment or maturity moment that people understood that not everything is buzz, but uh, I would say that a few of the VCs, they ride the buzz because they know that they will clear their position in two rounds or 5 years, and that buzz will still hold. So it's part of the probability of a portfolio, where and who will reach what stage, and are you going to take it all the way to the IPO with the pro rata, or just clear your position at a certain point. And it's interesting because we defined, and many people in the industry have been defining the different waves, first wave, second wave, third, whatever, in a different way, and cut it off based on years and not about the different trends. And we have multiple trends if it's only the underwriting, the products, going direct to customer, the AI, all kinds of things like that. So that can be a good follow-up episode later on. But again, it's a mental note for myself. Great. So before we already passed actually 40 minutes in, which was supposed to be only 30 minutes, but as always, when there is a great conversation and very interesting conversation, we have a tendency to ignore the clock. Before we reach the final question, who should we reach out to you? If people see this episode or listen to it on Spotify or watch it on YouTube or LinkedIn, who should reach out?
So there's a couple of ways you can reach me on. So I'm very active on LinkedIn. Just add me, email me. I'm very responsive there. And also you can reach us on support@asteya.world. I actually am on this email as well, because I like to make sure I support personally myself, customers, agents. I want to listen to them, because this is the most important part of this business, is feedback. If we're not in the customer service business, in which business are we? So I'm also available on this email. You can reach us there. The email is on our website. And if you want to reach out personally for me for advice on anything related to lifestyle, habits, running companies, I'm a curious person. I'm a lifelong learner. I don't stop learning. I've actually started my own podcast. It's called The First 100, and it's about how entrepreneurs acquire their first paying 100 customers, which is usually the hardest. So you can also leave a feedback for me on Spotify, Apple Podcast, or even email me. My email is in the podcast there. So these are three ways you could reach for three different user personas.
Yeah. Which now you remind me a different question that I had, because it's never going to end, my friend. You know, and this question is more about, with you tracking your vitals and all that stuff. I remember that there is the Vitality program and different life insurance that have all kind of programs of how to make you live longer, less about the quality of life, but more about longer, and you need to be a marathon runner to be accepted to most of those programs. Are you doing, or are you planning to have some sort of a program that will help people be healthier or have a quality of life so they will not have a challenge with their income insurance?
That's a very interesting question, and we've thought about it, but there's so many companies out there who are doing a much better job than us. So we're in the business of underwriting. So we create a product, we find the gap, and then we try to see risk profiles. Now, the healthier you are, definitely the cheaper the premium should be. The difficult part is, if we want to integrate your lifestyle into the rating, the challenge becomes with the regulator. Because when you file a product, you also have to file your rates, you have also to file the questions you ask, and then you also have to create your underwriting guidelines. It's quite challenging to use predictive analytics into what has been in the insurance industry, the rates built on history. And we've seen it in life insurance, right? If you look at the actuarial tables, the morbidity tables, they look at statistically. People aged between, let's say life expectancy is 85, they start to run their actuarial tables, they come up with a price so that on average, they don't lose money. The moment you start integrating predictive analytics, so today, one of the things that we've thought of is, why are we underwriting people on their calendar age? We should actually underwrite people on their biological age. Because in calendar age could be 50, but you have diabetes, you're in cancer remission, your biological age is much higher. You're at a higher risk of or lower life expectancy. Conversely, if I'm a healthy individual, I'm 40, but I don't smoke, I don't drink, I run every day, I eat a healthy lifestyle, I don't eat sugar, your biological age probably is lower. Now, integrating that into your rating is quite hard, because you need to convince the carrier, you need to convince the regulator, you need to convince the underwriter. So maybe it's something in the future we could think of when there's more strong acceptance to this idea, and then you could integrate it into your underwriting practice. Because the loss ratio, which is the key indicator here of if you're getting these predictive stuff into your underwriting correctly, is your loss ratio. And it's very hard to change today the dynamic of the industry around this. So we hope, I'm a big believer that we should be investing in this not as a company, but as a society and culture, and even ecosystem of companies, because that's the right direction. We should not be subsidizing the bad risks from the good risks. And that's what's insurance about. It's a pool of people where you have healthy individuals who pay the same premium as non-healthy in a particular variation, and that unhealthy person will claim. You would use that pool of premium, and it's not fair, right? But this is how it's been built out, and changing it on our own, it's very hard. So we hope that changes as people become more aware about this.
Okay, so finally we reached the final question for today, which is the same question that I'm asking everyone. Can you give us a tip, something that people should be aware of. It can be a good show, a book, a life hack, whatever you see fit.
Well, I'm going to move away from work, and I think the most important thing if you can do is eliminate sugar from your life. It's the
Oh,
worst
you're
thing,
killing me,
and
man.
we've seen
I have such a sweet
it in the
tooth.
US, right? I know, but we're at a record high, and when it comes to obesity, pre-diabetes, diabetes, and these are diseases that trigger multiple things and that cause a much lower health span, much lower lifespan. It's very hard to stop sugars because the industry, everything around us promotes it. It's in everything you can think of. It can be in food that you think it's not there. It could be in rice. You're eating sushi, there's sugar there. You'd be surprised. It's in every possible food that tastes good that's addictive, and unfortunately it's driving what's bad in the country. And I hope people could cut down. You shouldn't eliminate them because it's hard to stop unless you're extremely disciplined. You should start thinking about this ingredient.
Reduce sugar. Add fat instead. Fat is delicious. It's the
Healthy fat is amazing. Olive oil,
yes.
avocado oil, seeds.
Oh, I was going for a lamb, but okay, that works as well. Okay, fantastic. Hadi, thank you very, very, very much for joining me today. I think it was a little bit of a battle until we managed to do that. I think that originally we connected late September or early October, and we tried to find a schedule to make it happen. And finally, January, we managed to do it. Hooray! So
It's never
thank you.
late. It's never late.
I know. So thank you very much for joining me. It was a pleasure talking with you.
Thank you for having me, and I wish you the best in your podcast as well.